Welcome guys, and welcome to the first part of a many part series of a masterclass or a boot camp, whatever you want to call it. It is going to be everything you need in one place to master trading in general, but in particular swing trading. That is what has seen my success in trading, has been more of the swing trading route. I'm over 11 years now, coming up to 12 years shortly of live trading in the markets. And if you're new here, just for your peace of mind, I call every single trade I take live, always have done and always will continue to do so. I do this for a couple of main reasons, mainly to prove I am who I say I am. Secondly, to prove that my strategy is robust, it works in all market conditions and can stand the test of time of all natural market cyclical cycles. And third of all, it gives you guys an honest representation in a world full of such scammers and frauds and misinformation. It shows you that it's a strategy, my education, what I tell you is something you can trust and really double down on. So enough of that. Let's get stuck into things. And if you want to find anything more about me, there'll be a link below about my personal story of how I now trade over 800,000 of my own personal capital. But without further ado, let's get stuck into lesson 1. So guys, lesson 1 is basically going to be around price action and structure. So as you can see on screen, first of all, we're going to go through bullish versus bearish price action structure, what that actually looks like, because it can become very distorted and people teach it horrendously wrong. So we're going to start with that just so everybody's singing from the same hymn sheet and your foundations are spot on. We're then going to look at which time frames do we care most about with price action structure. What can we trust? What should we ignore? Again, because there's a lot of noise at times. Thirdly, what price and structure is relevant on those time frames? Okay, how much do we need to account for? How much do we need to look at? What is irrelevant? What do we need to take into account to make a proper decision and judgment to help us formulate eventually a fantastically highly confluenced, highly trustworthy area of interest. Next, we'll be bringing then that all together, as I've just kind of touched upon, about formulating a high area of interest that we can trade off and enter off. Next will be breaks and confirmations of structure. So when we can say, actually, that structure is held, we can continue on and take that trade, or actually when there's been a true break, a true confirmation there's been a break of structure and something's changed significantly, and when we need to go, fine, hands off, I can't trade this now because of that break of structure, which is hugely important, stops you taking lots of losses. And last but not least, when to act and when to sit on your hands, okay, which comes into that point we've just mentioned. So it helps you make the right decision over and over and over again. So let's get cracking. So to start with just bullish and bearish price action, okay? First of all, as you already know, bullish price action, we want to see clear series of higher highs, higher lows, higher highs, higher lows. And obviously with bearishness, we want to see lower highs, lower lows, lower highs, lower lows. So bullish price action would naturally look something like this. So we have formation from here, first bullish leg, okay, that's our first higher high. Then we come down, we form some form of higher low wherever that may form. Then we go on to our next higher high. And again, once that's topped out, once we've seen that leg stop, we can then come in for that natural pullback and form that next higher low. Okay, now if we go on to a bearish perspective, just get rid of all of that, we're obviously then looking to see, if we just change the coloring here, we're then looking to see that first leg to the downside. Okay, this forms our first lower low. We then get the natural pullback into our lower high, and then we come lower, again our next lower low, and again lower high into lower low. You get the picture. Now, the most important part of this, and we're going to give you live examples on charts in this video today, so it won't just be me on the iPad. I'm going to give you proper live reputable examples so you can actually apply and see what I mean live on the charts, because obviously that's where it's going to count and that's where it ultimately matters. That brings us nicely on to what time frames are we most interested in reading price and structure off? What can we trust? What do we need to ignore? So for me personally, and this is what I do to this exact day, okay? So I'm giving you everything you need here, okay? The monthly, the weekly, the daily, and the 4 hour, okay? These are your 4 main time frames. Now, the first thing I say about the monthly is this. The monthly, I'm not necessarily plotting any structure points, which we'll come into in a minute. I'm just aware of where price or what price is doing. Simply, are we bullish? Are we bearish? Or are we ranging? Which means basically we're not in that series of those lovely high highs, higher lows, or if we're bearish, obviously lower lows, lower highs, okay? Or are we flatlining, which is just another way of saying ranging. Those type of markets, whether it's regardless of any of these higher time frames, ranging markets we're not too interested in. It's when markets consolidate, which is normal, which is healthy, but we're not necessarily interested in trading that. We want that nice, clean, swinging structure we've already seen in this video a few minutes ago. So when it comes to the weekly, we want to then identify on the weekly, are we bullish or bearish? Okay. We then want to say, right, for this example, let's say we're bullish. We then go on to the daily. We're now looking for the daily to ideally be bullish, so it's in sync with the weekly. Okay, so if the daily is bullish, great. And then the 4 hour, ideally, again, we want to make sure it's bullish. So all three of those higher time frames, well, the fourth, if you include the monthly as well, are singing from the same hymn sheet. We're all bearish or we're all bullish. Okay, now there will be some exceptions to that. Okay, if I just get rid of all of this. There will be times when you will see price is bullish on the weekly, bullish on the daily, but the 4 hour is bearish. Now that is not to be scared of. That's not necessarily game over and saying we can't trade, because a lot of the time, remember what we said earlier, if that weekly and daily are put in beautiful new legs and we're going bullish to the upside, for those daily and weekly timeframes to then have a pullback, that 4 hour has to break bearish, okay? It has to start swinging basically lower, lower highs, lower lows, lower highs, lower lows, to allow, if the daily looks like that, nice and bullish, to allow the daily just to have that natural pullback to form that natural next higher low, the 4 hour will look something like that. So although the 4 hours bearish at that point in time, we can't forget what the higher time frames above are still telling us. The higher the time frame, the more trustworthy it is. Okay, so if the 4 hours looking like this at the moment, it doesn't mean necessarily game over or hands off. It just means we need to be patient and wait for price to come back into a highly confluenced daily / weekly higher low region. Okay, this is obviously if we're bullish. If we're bearish, it would be a highly confluenced daily, weekly, lower high area of interest if we're bearish. So when we see an example like that where the 4 hours temporarily out of sync, okay, it's turned bearish to allow for that bullish pullback on the daily and the weekly, that's fine. So as we are trading lower and lower and lower to maybe that daily higher low area of interest here, what we then want to see is, which we'll come on to towards the end of this video when it talks about breaks of structure, and remember, I'll be showing you live examples of this as well on the charts in a second. Once we then see price start to consolidate and range and stop forming that lower low, lower high, lower low bearish sequence, when we start to see price consolidate and slow down, that's a really good sign when it's approaching our area of interest. And again, I like to see this on timeframes like the 4 hour. I like to see this on timeframes like the 1 hour as well. No lower, because it's less trustworthy, way more noise, way more fake outs and bad stimulus we don't want to pay attention to. Okay, so when we start to see the 1 hour and the 4 hour slow in regions like this, brilliant. That's one step. Okay, the second stage though we're then looking for as a final confluence, and again there'll be other parts and other videos on this. The next stage we then want to see is a push away from that higher time frame area of interest. Okay, because what has that told us? That's told us the best confidence of all, that the market agrees with us. The market has confirmed and formed that confirmed higher low of that bullish sequence, and it's highly likely we're going to be then going on to that next leg to the upside, and so on and so on and so on. Okay, so a lot of traders will get caught out at this bit here because they'll see price just stall a bit and range a bit and think, brilliant, let's jump in the trade, off we go. Whereas actually sometimes price can consolidate like this before, if I just clean this up, before price ends up doing something like that again and continues lower. And that's when we come on to basically breaks of structure. So you've always got to wait to make sure there is a reaction and a push off and that the market has told you it agrees with you. So don't trade what you think is going to happen, trade what price is showing you and what it's telling you. Okay, it's reacted and respected your higher time frame area of interest, that next higher low, because we're bullish, market agrees with you, and then we can talk about entries and how we get involved. So when it comes to, again, we'll stay along the bullish example for now. We want to, how much price is relevant? Okay, how much price do we need to know about? So let's say you can see a bullish sequence on your screen at the moment that I've pre-drawn. Now, as you can see, we're in that nice optimal swinging price action structure. Okay, high highs, higher lows, high highs, higher lows, etc. Now, if we're at this area here, okay, at that higher high point, do I care about price back down here? No, I don't. Okay. What I care about, and this is where so many people overcomplicate things or overlook or look at too much. What I care about is seeing is that the most recent higher low prior to that higher high forming here, the most recent higher low, as long as we stay above that higher low, I'm happy and it's fair game. We are still looking for upside. So even if price from here decides to come down here, but then reacts off, we are still bullish, okay? Now, where a lot of people get confused here is, okay, a lot of people think that if we wick, so let's just draw on that higher low again. A lot of people think here, if we wick down here, then that's a break of structure because we wicked past it. That is bullshit. That is nonsense. That is not the case. So what is actually correct is if we came down here, so let's get rid of this. Let's just make it less confusing. Okay. So if we came down here and we body closed below that previous higher low here, then yes, that is a true clean break of structure. Wicks are not breaks of structure, okay? Wicks have shown where price has been and price has traded, but where that body closes at that 4-hour interval on that 4-hour time frame, or the daily interval, or the 1-hour interval, that body close is what's important and tells us the confirmation or the break of the structure, if obviously it's trading around that prior higher low. Okay, so if I just clean this all up again, okay, so let's go through it again. So quick sequence like so. So again, we're trading at this point here. All we care about is, do we stay above that prior most recent higher low? So not the higher low down here, just this one here. Okay, when we're trading at this next higher high, I don't care about this anymore here. Irrelevant, okay? Because we've gone on and made a new higher low there. So this is the most recent higher low we now have to account for. So if price, again, we've got to make sure price then stays above that region for us to then continue and see that next upside leg. I hope this is making sense, all right? And it will make more sense, or it will confirm that education for you guys when we go onto the live charts in a second, okay? Bear with me, technology is not my strongest point, okay? So if we just show you a bearish example, so we are coming down like so, lower high to the lower low, to the lower high, to the lower low, to the lower high, okay? Typical sequence that we're all aware of already. Now, if I just go back one, so at this point here, we then put in our next lower low. Now, at this point here, for us to stay bearish, what are we looking for? The most recent lower high. So if we're bullish, it's the higher low that we care about staying above. If we're bearish, it's the lower high, okay? So this point here. So if price comes up and trades up into here, as long as it doesn't body close above it, then we can still treat that as bearish, okay? Now, if it does get right up here, then we maybe just want to be a little bit cautious and sit on our hands in case it does break it. But as long as we body close and stay below, happy days, okay? So again, we come up and then typically that next lower high is formed and then onto that next lower low. Now, you may be asking me, Philip, How much price or what time frames do we trust these breaks or confirmations of these higher lows or lower highs on? I call them RSPs, recent swing points, okay? So the recent swing point basically refers to what we've just talked about, the most recent higher low if we're bullish, or the most recent lower high if we are bearish, okay? So I only utilize breaks or confirmations of structure, the stuff we've just gone through, on the 4 hour, the daily, and the weekly, okay? Even on the 1 hour, a lot of you might be watching this thinking the 1 hour is a higher time frame to you guys. It's not. I more utilize the 1 hour for entries and behaviors around entry criteria, okay, which we'll come onto in a separate masterclass. When it comes to 4 hour swinging price action, daily swinging price action, and weekly, those are the 3 time frames I care most about. Okay, so if I see a break of structure on the 4 hour, then I need to be hands off and cautious because my bias might have changed. Okay, obviously the same on the daily because it's even more trustworthy than the 4 hour, and the same on the weekly. Again, stay with me. This will make sense or reinforce the education on the live charts in a second. So just a couple of caveats before we get onto the live charts. As I mentioned earlier in this video, there will be times where you find the weekly is beautifully bullish. We'll see it in a second. The daily is beautifully bullish. And as we mentioned, the 4 hours actually looking bearish because it's just simply allowing the daily and the weekly to have their natural pullback to form that next higher low before we continue on. So in an optimal scenario, an optimal setup to me, before I even look at entries, the daily, the weekly, and the 4 hour have to be in sync. They have to all be singing from the same hymn sheet. So they're either all bullish or all bearish. Now, the caveat to that is sometimes the daily might be out of sync because it's allowing the weekly to have a pullback, okay? A deeper weekly higher time frame pullback. But there is a small caveat to this, and this is where the beauty of positive discretion comes in and learning this strategy properly. If the 4 hour, the weekly, and the monthly are all in sync still, they are bullish, and it's just simply the daily having a bearish temporarily pullback to allow the weekly and the monthly to pull back. This is very normal. This happens all the time in price action and structure. That, for me, is still a valid trade if price is trading around that highly confluence weekly area of interest. So if the 4 hour, the 4 hour and the daily, typically, the 4 hour will turn bearish to allow the daily to turn bearish. So typically when we reach that bullish weekly area of interest, once the 4 hours starts swinging bullish again and showing me bullish price action, I don't then have to wait for the daily to turn as well. I can take that trade, pending entry criteria, which is a separate video. I can then take that trade with the 4 hour being in sync with the weekly and the monthly. Because the daily, obviously, one daily candle prints for every 1 day of price action. It's basically 24 hours of price. Okay, so sometimes you might end up missing a really good optimal move because you've got to wait another 8 hours before the daily close happens just to confirm the daily's turn bullish again. And this is through pure live testing, forward testing, and back testing. I found that actually, as long as the 4 hours back in sync with the weekly and the monthly, those trades are fair game and optimal as well. So it does open you up to a bit more not variance of trade, but frequency of trades, okay? Because sometimes for price to be fully in sync on the 4 hour, the daily, and the weekly, depending on how many pairs you trade, there might not be a huge amount of trades that are optimal, that are ready, and that are, most importantly, in sync. So guys, you join us on GBP CAD. So what I'm going to do, I'm just going to go on a random bar, basically. We'll go for a decent bit though, fairly new age, so we won't stay in the 90s. We'll maybe go to, say, let's keep going. Let's select our own date. Let's go back a couple of years and we'll go to, say, March and start of a week, like that. So if I was looking at this right now, so you can see it step by step, this is what I do to this day. And if you've seen any of my other YouTube videos, you'll see this all the time when I do my trade breakdowns. So monthly, very cleanly bearish. Let me delete all of that. Monthly, very cleanly bearish at the moment. So applying the principles you've learned already in this video. When we were bearish here on this lower low, this bearish leg, we were bullish. So higher low to the higher high. This would have been our bullish RSP here. As you can see, this candle didn't break it, but this candle did, hence turning us bearish on the monthly. And then look what's happened. We've pulled in to make our first lower high, next lower low, next lower high, next lower low. So as soon as we broke this bullish RSP here and we turned bearish because of this leg, we're then saying, right, monthly's bearish, and look what then happens. Pullback naturally happens, lower high formed. I forgot to say on the video as well, the RSP is based off the bodies, not the wicks, okay? For the reasons I said earlier about the importance of body closures over wicks when it comes to structure and breaks of structure or confirmations of structure and formations of higher lows and lower highs. So then we made a new lower low, as you can see. So then where does the next RSP become? On that next lower high that was formed, the next lower low, so on and so on. So although I don't mark RSPs on the monthly, because obviously every candle's a month, that's a lot of days, that takes a long time to print new higher highs, new higher lows, new lower highs, etc. I'm aware, like I said at the start of this video, I have a quick scan of what's going on. We're clearly bearish, okay? Easy peasy, takes you 2 seconds to realise. So we drop down onto the weekly, and as you can see, the weekly was bullish here, okay? But again, where would the weekly RSP have been? There, because we were bullish, and that was the most recent higher low into the higher high. This body here, although it's subtle, okay, let me get that on properly. Can you see how we still broke it? Tiny body break, but a break nonetheless, and it's on the weekly, so incredibly trustworthy. Look what's happened. We've then followed through and dumped. So the weekly is bearish, okay? The daily, shock horror. The daily is bearish, okay? With how bearish the weekly and the monthly are, this is no surprise. And as you can see already, we've had a massive bearish leg to the downside. So at the moment, this, when we were bullish up here, this would have been, we could argue, our higher low before the next higher high. And obviously we broke it, nearly retested, and then we dumped, okay? So at the moment on the daily, we haven't had a lower high form yet officially. If we go on to the 4 hour, the 4 hour is just obviously dumping and dumping and dumping. So if this was me right now, although we are very much in sync across all time frames, it's beautifully optimal on paper, the synchronicity is there, we're not going to be shorting down at these lows, are we? We're going to want to optimize shorts, and we always take shorts off lower highs, just like we always take longs off higher lows. It's a better risk to reward, much safer. You're way less likely to get prematurely stopped before the trade plays out in your direction. So at this point here, I'd be saying to people, we know, this is structure and price. You don't need to know about all this stuff back here, as I said earlier on in the video, okay? I'm interested in basically when it comes to the daily, this most recent daily bearish leg, because we're bearish. On the weekly, I'm interested because we're bearish, so in the recent bearish leg, you get the picture, okay? If we were bullish and it was here on all time frames, at this point here, I'd only be interested in this bullish leg here. I wouldn't care about any of this stuff because it's irrelevant, okay? Don't get me started on support and resistance. It's incredibly subjective, and I just don't. I am not a fan of it, put it that way. So this is kind of basically what I'm getting at. And so that what I would be saying to you right now, if this was, this was live at the time, I'd be saying, right, well, we've got to sit on our hands because we've got to wait for some formations of lower highs to form, and then we're interested, okay? Now, at the moment, that's barely a lower high, in my opinion. That's just continued on dumping, okay? Look at that, continued on. So, at this point, it would still be sat on hands, sat on hands, sat on hands, and this is why I've got a decent watch list, because there'll be pairs where there's nothing for a week or two, but there'll be other pairs that are ready to go. So this is why I've got a decent, healthy watch list as well. So we've got to wait for this weekly leg to finish, basically. And at the moment, we are just melting and melting and melting. No, we still haven't finished. So you can see what I mean. God, this just absolutely dumped. Absolutely dumped. Okay. Nope. So, can you see what I mean? But if we go back within this, one way of being able to take advantage of this, and this is the beauty of the strategy, although we're heavily bearish on the weekly, heavily bearish on the daily, we can look for moves, basically, when we see, if we come up a bit, when we see price like this swinging fairly nicely, we can look to take advantage of things like lower high entries here. Okay, now it would have ranged a bit, it would have chopped a bit, and an entry like this would eventually take us out for break even because we were trading down here at one point, but then obviously prices come back and it probably would have stopped us for break even. Okay, but again, little examples like this, if once we'd seen this break lower, we'd broken out, of course, when this had broken lower and then pulled up and then gone into a new lower low again, and this will be saved for a separate video. But there's opportunities like this where we know we're bullish on, well, sorry, we're bearish on all higher time frames. We look to measure the range to see where price is most likely to retrace into, and we can then look to get some form of shorts off, and that's 15700, nice round psych number, 618 of the range, prior retest of that broken structure, and we can then look to keep stops just above that prior structure, and we can look to trade that into at least the first fib extension. That would be a 2.6 or 2.7%, or if not, those overall targets, that would give us a 3.6, and look how well things are respected. So I will save these type of things for another video because there's so much more I need to say on it and so much more context that needs to be given. But you get the picture. When things are all in sync and price and structures all swinging quite nicely, you are simply looking to buy from higher lows when we're bullish, and you are simply looking to short from lower highs when we are bearish. I will give you guys another example. So let's go back to another random date. Let's go back to 2024 and go to, say, October, and we'll go at the start of the week. Okay, so again, on the monthly, we can clearly see we are very bullish. Nothing more to say. Weekly, you can clearly see we are still bullish. But again, if there's ever a little bit of confusion, work it out. So higher high to higher low, to higher high to higher low, to higher high to higher low, to higher high. Okay, so this at the moment is our bullish RSP. If this stays as a higher low and continues on, then we can eventually move that RSP to there. And obviously we can continue to look for longs as long as we stay above there. Okay, so you get the picture. So the weekly, we're bullish. I'll keep the RSP off though. On the daily, we've actually we were bullish here. This is our bullish RSP. We technically broke bearish, but all that's done, as I mentioned earlier on the video, is just allowed the weekly to have a deeper pullback. And now look what's happening. We're starting potentially now to push and break higher. Okay, so the 4 hour at the moment is bearish as well. The daily is bearish as well. So would I touch this as we speak? No. But I know in the back of my mind, I'm still very much looking for longs overall because the monthly and the weekly are heavily bullish. Okay. If you throw in the British pound index, the BIXI, as well as further confluence, which I'll save for another video again in terms of synchronicity, you're laughing. You've got so much in your favor and you're always going to be trading with the trend. So again, the daily at this point is bearish. But what did I say earlier on the video? If the 4 hour turns bullish in this example, a 4 hour with the weekly and the monthly is still optimal. So the 4 hour bearish RSP at the moment is here. Okay, we came lower to the lower low, lower high, had a reaction off. Now we have failed to put in any new lower lows, and at the moment we're in a bit of a ranging no man's land. But if we break above here, then we've turned bullish. Okay, so let's just see what happens. Right now, this is not a trade. We need a bit more to happen. We need to be a bit more patient. But if we break out, there you go. We've had the breakout here. Okay, now the 4 hours officially bullish. Okay, and this is the again. I'm jumping ahead of the gun here on the masterclasses. But then at this point here, if the 1 hour or the 4 hour presents a nice higher low area of interest, okay, or a pullback, like so, okay, we can then look to take this long, okay? And if we go on to the 4 hour as well, look at that. Broke that prior RSP, we've currently retested it. Now let's see what happens. Can you see the beauty of it? It then pushes on. This is a random example, okay? It pushes on more often than not, and that would end up being, so if you ended up again having some form of long entry on that prior retest of structure, okay, you can see how, again, if we use the 1 hour to utilize where we can place some stops. Again, I'm jumping ahead of guns. Jumping ahead of guns. You know what I mean? And again, stop loss placement will be another thing. But you can then see how we're then able to take advantage of trades like this and so on. Does it continue playing out? Yes, it does. So we can delete that. That's for another video. It's a bit messy as well. But you can see what happens. We then break out, okay? So that would eventually have been a lovely trade taking it from here. So and then we've obviously gone to flip structure again. So guys, you can see what I mean, but you've got to get things in sync, okay? So it is what it is. All right? I really hope that helps. I hope you found that incredibly useful, helpful. It shed a lot of clarity, especially with the examples obviously on here, but also obviously then live on the charts as well. So you can really contextualize it and really start applying it and start stress testing it yourself from a back testing perspective, forward testing, and of course your journaling of your live trades. Guys, of course, if you want any deeper, further help with any of these topics that are going to be on this masterclass, feel free to reach out, book a call below, and we can discuss one-to-one mentorship or drop me a quick message on Instagram. I'm super chilled. I'm super easy. Other than that, guys, make sure like, subscribe. That'd be really appreciated, and keep post notifications on. So when Masterclass 2 drops very shortly, you'll be there and you won't miss it. Guys, as always, take care. Thank you.